Hello, everyone. It's Professor Reiko here, continuing on in our earnings per share chapter, and we're still looking at our dilutive securities and how they affect earnings per share. So this one's going to look at options, warrants, and rights, and basically they're all included in the computation of dilutive earnings per share only if they are dilutive. And mainly we'll just focus on options and warrants. All right, so we can look at a problem and tell whether options or warrants are dilutive. So how we go about doing that is we compare the exercise price to the average market price for the year. Okay, because remember that they haven't been extra. Remember, this is all hypothetical, right? When we're doing diluted earnings per share. So if the average market price is higher than the exercise price, they are dilutive because a investor would exercise the options and then go and sell it at the higher market price. Okay, so we can easily compare those and tell whether they're dilutive or not. All right, so how we go about doing this is what we call the treasury stock method. All right, now remember, I'm going to walk through this, but just keep in mind, none of this is actually happening. This is just how we measure the dilutive effect. All right, so what we're going to do is assume that the options are exercised. Okay, which means if you look back to the options video when we're doing stock compensation, that means the people that are exercising the options are bringing us money to buy shares. Okay, so what we're going to do is assume that all of them are exercised, options or warrants are exercised at the beginning of the year or whenever they were issued, and that the company then takes all the money they just received and goes out and buys as much common stock to hold as treasury stock. Okay, so because the way the market price is higher, when they get the money for the options, they don't, and they'll go out and buy as many shares as they can at the higher market price. But because the market price is higher, they are unable to buy as many shares as they need. Okay, and that means that they're going to have to issue a few more shares to satisfy the requirement to satisfy the option or warrant holders. Okay, so I know that's a little bit wordy, and basically this right here and this right here says they both say the exact same thing. Okay, and so it's a little bit wordy, but once we put numbers to it, I think you'll be okay with it. So let's look at this example down here, and basically I give you the answer within this example, but we'll write it out how I always write these out. So it says, assume at the beginning of the year the employees are granted options to acquire 5,000 shares of common stock at 40. Okay, so that is the exercise price. The average market price during the year is 50. Okay, so exercise is assumed, meaning people could buy it at 40, exercise their options at 40, and turn right around and sell it at 50. So that would be a smart decision. All right, so therefore they will be diluted. The proceeds from the issuance of stock to employees is 200,000. So the 5,000 warrants times. So basically, from right here down, I wouldn't give that to you on a test. This is basically the answer. All right. So the proceeds received would be 200,000. All right. So they're going to take that 200,000 and they're going to go out and buy as much as they can at the average market price of 50. Okay. That's going to allow them to purchase 4,000 shares. But remember, the employees are sitting there waiting on 5,000 shares. All right, therefore, we're going to have to issue an additional 1,000 shares to satisfy them. It's those 1,000 shares that we're concerned with. All right, so here's how I always write this out. I'll just say proceeds, and I'll say, all right, we got 5,000 options times my $40 exercise price. That gives me $200,000. All right, so now, and remember, the shares needed. So remember, we're assuming that they just gave us $200,000 to exercise those options. They are sitting there waiting on 5,000 shares. We are going to go out and buy. Remember, this is all hypothetical. We are going to go out and buy as much treasury stock we can. Okay, so that means we have $200,000, and we're going to go out and buy as many as we can at the average market price of 50. That allows us to buy 4,000 shares. Okay, and that means we'll have incremental shares needed of 1,000. All right, now technically this is the denominator, so it's 12 twelfths. All right, if you want to write that out just to be consistent. Okay, so that is the denominator effect. Now look, options and warrants never have a numerator effect. All right, if you go back and look at the accounting form in the earlier videos from this earnings per share chapter, nothing in the journal entries affected income. Right, it only affects equity and cash and things like that when we're dealing with the options and warrants. Therefore, there's no effect on the numerator. So I typically, in the other examples, I wrote out that per share effect each time. But for options and warrants, it's always 0 over some number, so it's always going to be 0. So I typically just never even write that out. All right, but that is how we do it. So these steps right here, anytime I have an option or warrant, and I could have changed this problem to say warrants, and we would have done it the exact same way, so it does not matter. All right, so make sure you're clear on this. Practice a few of these. We'll look at a few more, and then we'll put them all together into one bigger problem where we do have multiple potentially dilutive securities. Okay, so this is the treasury stock method for how we deal with options and warrants. It was a little bit wordy, I know that, but hopefully go back and look at what I said and then compare it to what's down here at the bottom, and you'll see we're doing exactly what it tells us to do. Okay. Once again, this is dilutive earnings per share, so none of this is happening. Notice we didn't make any journal entries. We're just saying this is how we measure the dilutive effect on earnings per share. Okay, hopefully that helps you understand options and warrants a little bit better as far as the dilutive effect of them. Please tune in next time as we'll continue rolling through. We've got a couple more videos with this chapter, and then we'll wrap things up. All right, we'll see you next time.